You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is Thursday. It is 1:30 p.m. Central, 2:30 p.m. Eastern Time once again for TWIFO. This Week in Futures Options, a program where the name says it all. We break down the week that was and indeed still is, from a futures options trading and trending and volatility and skew and all sorts of fun perspectives. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever scintillating Options Insider Radio Network, reminding you there's a legion of ways for you guys to get access to the audio content, of course, on demand on pretty much every platform under the sun: Apple, YouTube, Google Podcasts, Spotify, you name it. It's on all of those. Of course, the Audible, you name it. It's up there. Of course, if you want to engage more, join us live during the shows, ask questions of all of our guests and everything else, got to head over to the Plus. If you want to go above and beyond, get the great pro Q&A sessions, and of course, Options Oddities, breaking down all the unusual activity, and they have to go pro. TheOptionsInsider.com/pro is the place to go to learn more about all of that. And of course, however you're listening, live after the fact, keep hitting us up. Questions, comments, insights, pearls of wisdom. We do love to hear from all of you guys and gals out there. Let's see who we're hearing from today, doing double duty, holding down the CME and FTSE Russell hot seats, so he's got to squeeze into both of them. Our old friend, Mr. John Brady, the Managing Director of Global Institutional Sales over there at RJ O'Brien. John, welcome back to TWIFO, sir.
Thanks, Mark. Really appreciate you having me back.
It's been a little while, so we have a lot of fun stuff to break down. You last joined us, back in May, so it's been about 4 months, John. So we have a lot to get to. Are you excited?
I am, Mark, and I have missed you. So again, thanks for having me back.
I'm a very missable fellow. As we keep on rolling right on into our movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report. This is, of course, the portion of the show we break down everything that's moving to the upside, a.k.a. the light side, and to the dark side over there at CME this week. You guys can see this report for yourselves. CME usually tweets it out right before showtime. We always reshare it as well. So if you follow either of us, you should have access to this. And if you did so, you would see it's an interesting week. It's a little bit more evenly split than we have seen in recent weeks, even if some of the extent of the ranges is a little bit more in one direction or the other. But Mr. John, you are our guest. I will give you pride of place, sir. Where should we begin our journey this week? To the light side or to the dark side?
Why don't we start to the dark side, Mark, if you don't want?
I never mind going to the dark side. All of our guests are always light side, John. I'm glad to see you're breaking the mold. I like it. All right, here we go. To the dark side we go. Our bottom five here. Actually, an interesting week out here. The Russell 2000 almost sneaking in at number 7, off about 1.5% this week. But actual bottom five, it cost you about almost 2% to the dark side, 1.97%. That's what you need to break into the bottom five this week. That gets you to platinum. That was number 5 in the other direction last week, up about 0.8%. So it shows you how weak it was to the light side last week. By the way, before you ask, platinum does about 143 contracts a week, so probably not going to break it down on the show this week. A lot of metals this week, actually, on the dark side. Number 4, gold, off 2.01%, so just barely edging out platinum. We know gold does some paper, so we could probably hang out there. Number 3, the Eurodollars, off about 6.25%. It was number 4 in the other direction last week, up 4.17%. And we know Eurodollars does some paper. You don't need me to tell you that. Number 2 is silver, again to the metals, off 6.31%. And number 1 to the dark side this week, platinum. So pretty much everything outside of Eurodollars on the metals complex this week. Platinum off nearly 8%, 7.8%. It was also number 1 in the exact same direction last week, off 7.32%. So a rough couple of weeks, off nearly 15% for palladium. I said palladium. A rough couple of weeks for palladium. And by the way, again, before you get all fired up, 100 contracts on the tape heading into showtime. So not a lot of paper to parse in the land of palladium. Once you get outside of gold and then silver, I mean, even copper is a fair distance below it. So the volume kind of falls off in the metal space. Let's go to the light side, see what's lighting it up to the upside. Cost you 6.76% to break into the top 5 on the upside this week. That gets you to NatGas. Probably no surprise there. Anyone who's been paying attention to the news of late knows that NatGas has been on fire. A lot of issues out there. We'll probably get to that later in the show. It was number 2 in the same direction last week, up 7.3%. So you're talking a combined about 14% in the last couple of weeks. So it's a big run. And then corn, number 4, up nearly 7%, 6.96% to be precise. It was number 4 in the other direction last week, off about 3.7%. Number 3 is oats. So we got some ags lighting up this week, up 12.76%. Oats, not really a big options player. 104 contracts on the tape so far this week. Number 2, lumber. Again, it's a week, a day. Pick a minute, whatever period you want. Chances are lumber is moving the most in that time frame. And lumber, once again, lighting it up to the tune of 16.72% to the upside. It was number 3 in the other direction last week, off nearly 4%. So a pretty big swing in the last couple of weeks. And then, of course, lumber, we know, we talked about it before, not a lot of options paper to be found out there as well. And number 1, yet again, my goodness, iron ore, up 20.99%. So pretty much 21% to the upside this week. That's the largest upside move we've seen in quite some time, percentage-wise. And last week, it was up 15.21%. So just insanity abounds out there in the land of iron ore. And I wish this would be a perfect product to have options on, and yet really no options trading out there. So the thing's moving 21% in a week and no options to be found, unfortunately. But John, as I mentioned, the only thing breaking into the dark side that wasn't a metal was Eurodollars. I know you like to hang your hats in the rate, so I think we'll start our adventure there first.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, everybody, welcome to the world of rates, where we break down the action going on over there in the rates complex on CME this week. And John, as I mentioned at the top of the show, it's been about 4 months, almost exactly, since you've joined us on the show. A lot has happened in the world of rates since then. Of course, recently we saw Powell and his crew over there getting a little bit of vol, injecting a little bit of turbulence into the market with some concerns about tapering. Then, of course, later on they came out and gave a little bit more insight, a little bit more roadmap into what they're planning going forward. So it seems like they dialed back some of those tapering concerns. We saw a lot of paper in the rates complex as a result of all of that. But catch us up. I know you watch rates on a pretty much daily basis out there, and a lot of your customers out there are trading the rates. What's been lighting up your tape since your last appearance, and what are your customers up to out there these days?
Well, Mark, I think the story really here is what the market's kind of lost a little bit of its bid in the post-CPI trade. As you recall, earlier this week we saw a CPI number that was a little bit softer than expected within the core numbers, and the market sort of reacted accordingly with a rather large drop in yields that has now proven to be unsustainable. And then this morning, of course, we received some stronger retail sales numbers and Philadelphia Federal Reserve index numbers from the Philly Fed that were both stronger than expected. And so the bond market's kind of given this back a little bit. The curve has steepened. It's lost its early week flattening bias. Curve has steepened out. And there sort of seems to be a general sense that even though the inflation data on Tuesday morning was a little bit weaker than expected, the Fed is still on target to taper. And so the schedule of tapering and market expectations for Fed tapering is as such. They'll most likely use the September 22nd FOMC meeting to further cement market expectations for a formal taper announcement at the November 2nd FOMC meeting, with a tapering program scheduled to start in and about the December FOMC meeting mark. And Eurodollars, specifically greens and blues, and what we would call sort of the swap equivalent of the belly of the Treasury curve, has sort of reacted in sync with this idea that, look, the Fed is going to begin to taper in 2022. They'll be rather aggressive about it, given still elevated inflation readings. The general market consensus right now, and I think the Fed wants to pay attention to market consensus because they don't want an increase in volatility. That is really important for your investors and for your listeners to remember. The Fed does not want to make the tapering process a volatile process. So greens and blues has sort of softened a little bit against the very front of the curve. There has been a little bit of a steepening trade. But really, the Fed is going to be aggressive in their tapering. And current market expectations are for the Fed to taper each and every month, reducing their purchase program by $10 billion a month in treasuries and by $5 billion a month in mortgages, meaning that by the beginning of August of 2022, a short 10 months from now, the Fed will be completely out of the purchase game and the quantitative easing game. That's not to say they're tightening. It's not to say that they're selling their inventory of securities. They'll maintain a $7 trillion plus balance sheet, but at least they'll be out of the purchase game within the market, which should allow silly old concepts such as price discovery, price dispersion, and other natural market forces to sort of reemerge within the term structure of interest rates.
Let's get out there into that term structure. Like I mentioned, Eurodollars once again lighting it up this week, this time to the dark side, off about 6.25%. You guys know where to go to find all these reports. We're going to break down throughout the show. CMEgroup.com/TWIFO, TWIFO, or /TWIO, TWIO. Both of those should get you these reports. Go on over to the drop down, scroll on down near the bottom. Second from the bottom there is interest rates. Then get on into U.S. rates and Eurodollars right there at the top. Before I start breaking down the Eurodollars, you kind of just mentioned the greens and the blues and all that fun. Do you have a lot of clients out there in the Eurodollars right now, John? And if so, what are they up to, sir?
You know, Mark, we do. And really sort of the idea there is it's sort of a better sell on strength trade. And here's the reasoning behind it. Fed policy, i.e. that old dinosaur of an interest rate tool called the Fed funds and overnight rate, that's not going to be touched for a little while. So front-end Eurodollars, contracts, let's say, expired in 2021, maybe 2022, will continue to sort of converge towards the Fed overnight rate. And there's not really a lot of activity in those very front contracts. Where the activity is further back, what they call slope of curve, or sort of those deferred LIBOR forwards. And really kind of the trade there is one of two. trying to time or sort of pin Fed interest rate hikes. So, for example, Mark, in the December 23 futures contract, which is your first green contract, that currently trades at 98.96 in terms of CME pricing. It also implies a yield of about 1.04%. So the market by December of 2023 is implying that the Fed will have raised interest rates by 50 basis points, maybe even 75, by the close of trade in December of 2023. So the market is implying that somewhere beyond 2022, the Fed will begin an interest rate hike cycle. But before they hike, the market is also going to price in the fact that the Fed will no longer be buying treasuries in this quantitative easing program, this purchase program they currently have undergone. And a lot of their purchase program, Mark, as you know, has really been in the belly of the treasury curve. It's been in the 5, 7, 10, maybe 15-year sector. They really don't get too heavily involved in the ultra-long bond, the 30-year sector, and they don't get too involved way up front, given sort of supply dynamics that are going on with the T-bill market and very front-end bills. So they being the Fed, like to concentrate their purchases in the belly of the curve. The greens and the blues, on a duration basis, sort of tend to mimic the 5, 7, and 10-year part of the Treasury curve. And so the steepening or cheapening that we've seen in green and blue Eurodollars is also reflective not just of forward interest rate hikes by the Fed in 2023, but also a cheapening of contracts based upon the fact that the Fed, the market's current most inefficient, largest, but most uneconomical buyer of Treasury securities, will be leaving the market shortly, and the market's priced that in as well.
No, you just reminded me, John. I keep mentally making a note to bring you back on one of these days to do a deep dive explanatory show on the Eurodollars. I know for a lot of our audience, it's still an overwhelming and intimidating product. I mean, you just mentioned all the different colors, the pinks, the reds, the blues. It goes out for years. I mean, it's an overwhelming product for a lot of newcomers to the world of options. I think someday, John, in the future, we'll have to get you on, and we're just going to do a deep dive into all things Eurodollars. What do you say?
No, look, I would love to, and for your listeners, Mark, I'd be honored to do it. But also, the Eurodollars can at first seem rather intimidating, but they're not. Certainly, we have a pool, the firm, R.J. O'Brien, as well as the global customer list of CME Group. It entails sophisticated users of the products, but there are multiple applications for the user of the products, right? Whether it be the futures market or the options market on the underlying futures, there are many applications. So, for your listeners out there who see themselves maybe, or perhaps feel a little bit intimidated by the sophistication of the product, they shouldn't be. There are many simple applications for the product that can be used in a number of different formats or a number of different applications. So it's a great product. It's probably the benchmark. It's the futures benchmark product globally. There's not a contract around that has higher open interest or higher daily activity. The liquidity, the depth of liquidity, whatever else, makes it the benchmark global futures product around. And look, I'd be more than happy to come back sometime and chat with you a little bit more about it and do a deeper dive if you'd like.
Yeah, we're already getting some questions on this. We'll break down some of the Eurodollars activity this week. And by the way, there is a lot of it, as you would expect. Eurodollars pushing almost 2.5 million contracts right now, listeners. 2.4 and a quarter or so, to be precise. So parsing individual months sometimes kind of like looking for the individual droplets of water in the hurricane out there. But we shall struggle forth nonetheless. By the way, the volume in Eurodollars, unlike we talk about equities a lot, 30+%, 40+% of it goes up in the contracts that are going out within a week or 2 weeks at the most out there. Eurodollar is not that kind of beast. It's spread all over the place, as John was kind of just breaking down, because this contract goes out very far, actually. So the most active month this week was actually only had about 12.2% of the paper. And that is not unusual out there in the Eurodollars. That's the DEES contract expiring in about 85 days over here, listeners. By the way, if you're wondering, the vol out there in the Eurodollars, as you might imagine from the fact that it's in our movers and shakers every week, pretty frothy, at about a 33.10 in this contract right now, up about a little over a point. So for everyone out there wringing their hands saying they can't find any vol in the equities anymore, and you have a day today where the equities are selling off and vol is also selling off, rates, at least from the Eurodollar flavor, maybe not the 10-year, but the Eurodollars at least could get you a little bit more juice out there. Skew-wise, we had the puts last week in this D's contract, 10.7% risk to the at-the-money last week. This week, 13.7%. So getting bid up by 3 points. The calls last week, 14% cheap. This week, 12.1% cheap. So we have a skew resembling what we're seeing in the equity space. So again, something that's reminiscent to a lot of our equity options traders out there. The calls are offered, the puts are bid. Perhaps not to the extent that we're seeing out there in, let's say, the E-mini or the Russell 2000, but still intriguing stuff nonetheless. And in terms of the most active contract, I do love the eighths and the teenies. Going back to these, it's like back to my old days, the early days on the SIBO there for me. 99 and 3/8 puts lighting it up this week, number one in D's with about 111,000 contracts. Just for frame of reference, listeners, just this one put throughout the week did more than a lot of the metals complex combined out there this week. The most active day was Tuesday, nearly 70,000 contracts going up on Tuesday, 69,662 to be precise. Of that, 30,000 of it was opening, so a little over half. 11,000 went up on Monday, 30,000 went up on Wednesday. Today, not so much, only 352. I do love the way Eurodollars work, where they can just print contracts and then go dark almost the very next day. It's a fascinating thing. You don't see that in a lot of other products out there. So a lot to parse. Again, we could spend a lot of time out here. But before we roll out of rates, John, we're actually getting some questions from the live chat. You guys know if you're in the pro side or the plus, you guys get bumped to the top of the list. So I won't make you wait till the futures options feedback. We'll get some of these questions in now because, John, I know rates are kind of your bailiwick here. Let's go out to, what do we have here? Nichols first. He says, John, what is the best intro product for newer rates traders? I'm guessing it's probably not Eurodollars. Yeah, that's probably a good guess, Nichols. So, John, you have a customer coming to you at RJO. They're maybe getting started, getting their feet wet in rates for the first time. Where do you tend to steer them?
Go to the Fed Funds Futures market. Fed Funds Futures is very simple and very easy. It's a contract that's not moving much in terms of Fed policy and whatever else. Again, markets we discussed earlier, right? The Fed may be tapering their asset purchases soon, but they're certainly not moving front-end benchmark overnight interest rates. They're not charging more for money in the overnight interest rate market. So for new beginners, the best sandbox is to go to the Fed Funds Futures market and learn how that works. It's a very tight, very deep, very liquid market. Very simple in the fact that the contract rolls off monthly and it settles to an average price of the underlying Fed funds rate. So that is probably the best place to kind of go and get your feet wet, learn a little bit about simple short-end interest rates, and then you can sort of build upon that to go further out into either the LIBOR market, which is Eurodollar futures, or into the Treasury market.
I like that. Great answer. Fed funds. I like that term, too, the beginner's sandbox. I may have to borrow that, John, if you don't mind. Hope your licensing rates are reasonable.
No worries.
All right. If you got more in you, we won't make the folks wait till the futures options. They want to get at you now, John, so we'll let them. You got Frank now in the live chat. Frank saying, is John surprised that the Fed hasn't been too aggressive with inflation and has been dismissing the recent inflation as, quote, temporary? And does John agree? John, you're just talking about the tapering, about Fed's plans for tapering. A lot of people pointing out that, in the past, previous Fed regimes, Greenspan and his ilk, very much inflation hawks. This new regime, not so much. In fact, as our listener points out here, they kind of dismiss all this current inflation as temporary. A, does that surprise you? He wants to know. And B, do you agree with this viewpoint that this current realm of inflation is just a byproduct of the pandemic?
So I think, Mark, Frank's question is incredibly insightful. And that is a major discussion point amongst significant participants in global interest rate markets. And I'm going to answer it this way. Sure, the Fed has allowed inflation, has almost encouraged inflation, to go to levels that we last saw coming out of the global financial crisis. And before the global financial crisis, we haven't seen since the early 1980s. I mean, you have CPI running at a 5.3% clip on an annualized basis. You have the PCE deflator running at over a 3% clip on an annualized basis, even close to 4%. And for an organization and for an institution like the Federal Reserve, whose job is to take the punch bowl away as the party really gets going, I think a case can be made that they have been very irresponsible in allowing a general increase in the price level. Another way to say that, Mark and Frank, is to say they have allowed a real depreciation in the purchasing power of the U.S. dollar. You don't need to listen to me. If you're in the grocery store tonight, go price up some of your favorite goods. They're much more expensive today than they were, let's say, a year ago or 5 years ago. But underlying Frank's question, Mark, we'll take it even a step further. And I think that, unfortunately, it's kind of a bad word these days, but I think we want to be transparent here. I think politics has entered into the equation here in terms of what the Fed is thinking. And specifically, I would remind your viewers, without getting overly political, that Fed Chairman Powell, his term as Fed Chairman, comes up in January of 2022. And there's a lot going on in Washington, D.C. right now, whether it be the reconciliation bill on infrastructure trying to be passed by the Congress. There's a bipartisan infrastructure bill that seems to be attached to the reconciliation bill that likewise has to do with infrastructure. There's the debt ceiling debate coming on up soon, which is going to extend government funding, and that is a political hot potato as well. And then you have the chairman's reappointment. And within Washington, D.C., where the political boil is rather high, you have one party who seems to want to have Powell reappointed, continuity at the world's largest and most important central bank. And then you have people who want to have him replaced with someone who's perhaps maybe a little bit more idealistic or perhaps a little bit more progressive. And whereas I'm not going to get into that debate, I would suggest that from a purely objective standpoint, and our clients, we tend to have these conversations, is that the Fed chairman doesn't want to rock the boat. He wants to be reappointed for another Fed chairmanship. And the only way to do that is to sort of perhaps rake the leaves the way the White House wants the leaves raked. And so staying lower than otherwise and keeping policy lower than otherwise and easier than otherwise increases the opportunity or the chances that Fed Chairman Powell will be reappointed. Now, over the last 20 years, the economy has seen disinflationary, if not deflationary pressures that have emanated from a number of different quarters. An aging population, global technology, the emergence of China, cheap exports, everything kind of holding prices lower than otherwise. So for the Fed chairman now and for the Federal Reserve Board to keep interest rate policy lower than otherwise, it's probably not going to be the end of the world. But there is a political element to it that I think your listeners want to consider, and that is Fed Chairman Powell is looking to be reappointed, and in order to get reappointed, he's got to make the big boss happy. And the way to keep the big boss happy is to do what the big boss wants. And our sense is the White House wants interest rate policy and particularly Fed policy to remain right where it is.
You know, it is funny, John, for supposedly independent party there, the Fed. Surprisingly, the rate hikes tend to fall off in that final year of the Fed chairman's tenure. Isn't that so surprising, John?
Well, it's funny, Mark. You're exactly right. But really, the Fed's always been a political institution. It's just that the light, I think, has now been shown on it the last couple of years. You, of course, remember former New York Federal Reserve Bank President Bill Dudley wrote an open letter about, 2 years ago, 18 months ago, calling on Federal Reserve policymakers to use their tools to affect the economy and, in another way, to affect the outcome of political races. Now, I'm not going to kind of go back into it. That letter's out there, and that's kind of historical fact. But like most central banks globally, there tends to be a political input. Your point is very well made. I completely agree. The Fed has long been a political institution. You can take it back to Arthur Burns. You can take it to Arthur Burns and Lyndon Johnson, Arthur Burns and Richard Nixon, where whip inflation now, when, and all that type of stuff took place in the late 60s and early 70s. But I think in today's day and age, the light has shone more brightly within the political dynamics of the Fed and within Congress that oversees the Fed, within Treasury, which is a member of the executive branch. The political pressure on the Fed today is probably as intense as it's ever been.
We have to keep on rolling. We might talk rates for the rest of the show, but there are other complexes lighting it up, including the energy complex. So let's hang our hats there next.
It's time to tap into the deep options well of black gold, Texas tea, NATGAS, and more. It's time to talk energy.
All right, everybody. Welcome to Energy, where we dive into all things energy, usually This is the portion of the show where we dive into WTI, but not this week, listeners. No, because it's been NatGas that's been catching everyone's attention, making a lot of headlines. Like I said at the top of the show, up 6.76% just this week. Last week, up another 7.3%. Talking over a 5 handle now in the front future in NatGas, listeners, which if you follow NatGas at all, you know that's a pretty rich level. You know, what's been going on out there? Well, a number of things. Obviously, NatGas is a very seasonal product. So, of course, you have some concerns over a cold winter. But also, we're seeing a lot of storage issues out there. In Europe, in particular, it seems to be a big issue with their storage levels well below where they normally are this time of year. So that's driving up prices. You might say, well, so what? You know, U.S. kind of has its own deal. NatGas has usually kind of been a bit of a siloed product, but watchers of this space and people who track the correlation are starting to say, you know, that's starting to go the way of the dodo. We do export a lot of our NatGas, obviously. So we're seeing higher correlations. It used to be around 50%. Now it's getting close to 90-odd% correlation between what's going on in the European market and what we're seeing here in the U.S. So whither goes the European market, so goes the U.S. NatGas market. Hence, we're at a 531 right now coming into showtime, John. So, John, obviously a lot's going on in the energy space. I'm sure even if they don't normally trade NatGas, you probably have a lot of people calling you up, asking you about this marketplace right now. It's making all the headlines these days. So what are your thoughts on what's going on in the exploding world of NatGas, sir?
So, Mark, look, you know, NatGas there's definitely a seasonality to it, right? So on a kind of a forward-looking basis, right, as a trader, as an investor, right, the trade tends to be you buy the dip in NatGas when the weather's really hot, and you sell the rally in NatGas when the weather's really cold. And I think that this year, because of different geopolitical events, that move has been kind of exacerbated a little bit, and it's kind of has been brought forward. Look, I think one of the things driving it certainly is commodity storage, right? Has enough natural gas been stored up for what apparently is going to turn out to be a pretty cold winter? You know, likewise too, Europe shortages are very acute, and the amount of gas in Europe as well is very low. And likewise too, I think that I think that there is a belief that within the climate legislation and push for climate regulation, it looks like NatGas may be kind of the big winner. So at the expense of black gold and crude, it looks like NatGas, I don't really, trade the spread much, but from a medium and longer term perspective, it looks like NatGas, sort of the cleaner gas, is going to be preferred as opposed to crude oil. And I think those are dynamics you're kind of seeing right here, right now. But I think in the very short term, I think it's going to be it's very much going to be it's a commodity storage story within NatGas, and the belief that winter, and again, this is a forecast, that winter is going to be exceptionally cold. I would caution your listeners that sometimes forecasts don't always come to be accurate. And so when for a trading desk like ours, when we see something like natural gas take off the way it does, we see two opportunities. A, try and maybe catch a trend if we can, but B, always be sort of sensitive to the idea that puts might become mispriced relative to calls if there's a seasonality, if there's a traditional seasonality of the underlying commodity, and if the forecasts don't come out, if the forecasts are not fully realized. So we would suggest to your listeners that those are two things you kind of want to do. A, find sort of the technical place maybe where you can kind of catch the trend, certainly being sensitive to the storage story that's out there for natural gas, and the underlying sort of macro story, which is that natural gas will benefit at the expense of crude oil, but also two, look for mispricings in the put market, especially puts versus calls. At some point, calls will become very rich, and they'll become very rich in relation to puts. And those are things that we would look for, and maybe kind of advise your listeners to look for as well.
Well, you mentioned mispricings and indeed the seasonality of NatGas and how a lot of this is short duration going into the winter. Talk about a backward curve. That's exactly what we're seeing out there in NatGas right now. I said that front future at about a 531. You go all the way out to February and March of next year. February is at about almost a 550. And then it starts tapering off by March. It gets to about a 5.10 or so. And then it falls all the way off by April. It's back into the 3 handle again. So that front portion of the curve, obviously pricing through the winter, getting into that seasonality again, is just extremely pricey, extremely rich right now, listeners. And interestingly enough, you don't always see this in the energy complex, but we are seeing it right now. It's all of the action right now in NatGas, very near data. This looks like an equity right now. 38% of the paper that went this week. And by the way, a lot of paper went up. What are our numbers right now? 664,000 contracts on the tape in NatGas right now. So yeah, that's a lot. And we're seeing 38% of that going up in the contract in October that goes away in about 11 days. So that's equity kind of numbers. Very, very near dated paper. But again, looking at the front portion of this curve, it's kind of hard to argue with that. So I guess we'll have to hang our hat out there. We'll make an exception this one time. Usually we like about 2 weeks to break down the vol and the skew, but again, we'll make an exception out here. What is the vol in this front portion of the curve, you might add? It's a 60 and a quarter, which again, I just broke down how much NatGas has moved just in the last 2 weeks. It's hard to take issue with that level. It's up 13.5 points just this past week. So again, everyone who's wringing their hands about equity vol, there are other complexes that have a lot of vol to bring to the table if you're willing to look. In terms of the skew, last week the puts 3.1% cheap. This week, 5.3%. So not a lot of love for the puts. Calls are where the action is. At least they were last week. 6.2% rich were the calls last week. This week, about 4%. So the calls have actually come in, which again, you're blowing through some strikes. You're going to see that bid hold up for a little bit, but eventually you're going to see it fade. And it seems like we're seeing some of that right now. In terms of action, out of the money calls were where the action was this week, listeners. It was these 6 calls, these 6 even calls, which again, we just had a 3 handle in NatGas not too long ago. So talking 6 calls and putting up all these numbers, it sounds kind of outlandish, but that is where we are right now, listeners. 35,500 of these 6 calls going out in 11 days went up this week. The most active day was yesterday with about 11,700. Today, we have about 10,700, so a pretty active day today as well. About 8,500 on Monday and about 4,500 on Tuesday. A lot of back and forth on the strike as well. It wasn't just all opening all week, so people were slinging the 6 calls fast and furious all week long. Followed right behind it by a strike that might make a little more sense, the 5 puts. These now out of the money puts, which is also crazy to say, did about almost 32,000 contracts. So they were a neck and neck with the 6 calls there. The most active day actually today, 17,300. So over half of that 31,700 contracts went up today, followed by 6,500 yesterday, 3,700 on Tuesday, and about 4,200 on Monday. Obviously, mostly opening earlier in the week. We don't know what happened with today's paper, but man, that's a lot of paper to be found out here in NatGas. Let's look really quickly, see if we see any other aberrant prints. 5 half calls, a little bit, I put in quotes there, a little bit more reasonable calls. About 25,000 of those also trading this week. The biggest day for those was Monday with about 9,000. 5,000 on Tuesday, 6,500 on Wednesday, and about 4,000 today. Back and forth opening and closing on those as well. People are going back and forth on that strike. That makes some sense. Let's do it real quick. Let's do 4 here is number 4. The 4 3/4 puts about 20,000 of those. The big day also today for those, about 9,000 going up today. So nearly half of the paper going up today here. Let's do a top 5 really quickly. Number 5, 5 3/4 calls. Again, not that surprising. 16,000 of those going up. The big day for those was yesterday, about 5,700. Just go out really far. You know, if that's not optimistic enough for you or outlandish enough for you, we also saw 15,800. So almost in the top 5 here. Just a few hundred contracts behind the 5 3/4 calls going out in a couple of weeks. We have the March of 2022 10 calls. Yes, the 10 even calls. My goodness, going up 15,862 times this week. Looks like the big day was Wednesday. Looks like the 8s also went up 5,000 because they went up 5,400 times on the 10s on Wednesday. But we also saw the 8 calls trading 5,200 times. I have to hope and or pray that was at least some vertical action, not some straight up buying of the 10 calls. That would be pretty outlandish. But there you go. That's what we had going up. We also had 2,200 of the 7s, so maybe the 7s, 8, that doesn't line up that well for the fly. But still, a lot of action on the 10 calls and the 8 calls all the way out in March of next year. So a lot of paper here, a lot of action in the front portion of the curve. If you've been intrigued by energy in the past, maybe it's worth at least taking a look. These are pretty volatile markets, so obviously be careful where you tread, but worth at least keeping an eye on what's going on out there. Speaking of keeping an eye on things, we're coming up against it here in the show. So let's keep on rolling. You guys all have volatility on the brain, so let's head out there next.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, let's get down to brass tacks here, break down some vol and some equities. You guys saw from our earlier shows just today, we have seen a little bit of a sell-off out there in the major indexes. Actually, I take that back. Now, as we come into TWIFO here, the sell-off has mitigated, and we're seeing green on the screen again today. So all the vol that was coming in when we saw the markets down, it's going to come in even more now, obviously, that the sell-off has turned into yet another rally here on the week. Coming into showtime, we had the RVX at about 25 and a third. RVX, of course, the VIX of the Russell 2000. That's down a little over a point, about 1.3 points from last show. Of course, right now, it might be even lower given what we're seeing out there. So again, still hovering in that mid-20s range in the RVX. VIX coming into showtime was at about an 1883 out there. I have a feeling that's probably a little bit lower now as well. Yeah, it's in the 17 handle again, so that's given up almost a point, even since the show started. That's what's going on out there in the world of vol. Vol's moving quickly out there these days, listeners. So that puts VIX, from where we started the show, up slightly on the week. Of course, it has given up a lot of that now. VVIX at about a 115. That's down about half a point from where it was this time last week, but pretty much close to unched. Vol Q, a.k.a. the at-the-money vol of the NASDAQ 100, was down about 3/4 of a point, about a 16.15. That means at the start of the show, at least, the VIX to RVX spread, so the small cap to large cap vol spread, was at about a 6.5. That's about a 1.5 wider than it was this time last week. And then, of course, we had VIX to vol Q, which was, of course, the NASDAQ to the S&P 500 vol spread. That's almost a 3, about 2 3/4. That's about almost a full point wider than it was this time last week. So interesting stuff afoot. John, I'm sure you have a lot of equities clients out there who are calling up, asking questions, what's going on in the equity space, as well as what's going on from a vol perspective, sir. So what are you telling them these days?
Well, we're talking about a few things, Mark. First, there's a seasonality to equities as well, and I know I kind of leaned on that argument when it came to natural gas. But as you know, September and October, really August, September really tend to be historically the tough months for equities. October gets all the press and the headlines because you've had crashes during those months. But really, the more painful, slower sell-offs tend to happen historically in August and September. And look, the equity markets have kind of put a little bit of a short-term top here, but and I think there are reasons for that short-term top that correspond with what's going on in the interest rate market. And I don't want to bore your listeners by going back to the interest rate argument, but Fed taper, reconciliation bill, higher taxes, Fed reappointment, Fed chairman reappointment. Those are all issues that I can assure you the equity markets are paying attention to. But longer term, Mark, or I would say maybe even medium term, we think any sort of significant pullback in equities or any pullback in equities is really is most likely going to be met with good buying. There's about five. Here's an interesting fact for those who kind of look at equity valuations being a little bit on the higher side, stretched a little bit in terms of, let's say, PE or the ratio of valuations to sales, and that is that there's $5 trillion. That's the bigger number with a T. $5 trillion. U.S. dollars sitting in money market funds, and most of that money is yielding 0%. And so with equities, any sort of pullback, whether it's going to be 5 or 10% or whatever it's going to be, is probably going to find buyers. And so I think what the street is going to do, and perhaps a little bit of this belch trade or this burp trade that's gone on with equities here in the last 2 weeks or so, really since Jackson Hole, the Jackson Hole conference put on by the Kansas City Fed, what's really kind of gone on is there's been a sort of a reassessment in terms of what earnings growth will be like in 2022 compared to 2021. And what you've seen kind of larger dealers and investment banks sort of mark down their earnings growth outlook for 2022 to sub 10%. So remember the comparisons for 2021. The hurdle was easy to make because 2020 was so poor, right? The pandemic. And I think we're kind of fully priced there. Now, when you look ahead to 2022, the comparisons in terms of earnings, revenues, income, whatever else, are going to be a little bit tougher. And so you're seeing analysts sort of downgrade their forward expectations to something closer to 8-9% growth in 2022. And I think the market's kind of reflected that, as well as all the other things that we mentioned earlier regarding interest rate space. But again, for your listeners, $5 trillion is a lot of money. And it's really tough to see. I think a lot of that money that's earning zero in short-term interest rate accounts is only looking for a reason or looking for an opportunity to go to work. And I think any sort of pullback whatsoever in equities would be rather short-lived.
Yeah, it's kind of hard to argue against $5 trillion sitting there in those accounts. Let's head on out there. I know you're an E-mini guy, so let's head on out there right now, listeners. Of course, go to that drop down. Go to equity indexes, go to U.S. indexes, E-mini, and then go to the E-mini S&P 500. That's where we'll begin our journey this week. And as is the case with pretty much every equity option under the sun, the lion's share of the paper this week, and there has been a lot of paper, 2.25 million contracts on the tape right now in the E-mini. 43% of that is going up, or I should say has gone up, in the contract that has less than a day to go, 3/4 of a day left. So that's impossible to parse from a vol. If you're wondering what the vol is, quote unquote, in that contract going away, that's about a 10. Let's go out. We have 11.5% in the contract that goes out in, let's see, about 4 days. I mean, you just can't find anything, anything that trades with any sort of frequency. So that has any sort of, I guess we'll have to break down this contract that's going away tomorrow because it's so front heavy, listeners. Every other month, the most you can find, I got an 8% here for the week 3 in October. That has a whopping 29 days to go. Maybe we'll head out there just because you can't parse skew in a contract that has 3/4 of a day left to go. Let's go out here. The vol in the October week 3 contract, if you're wondering, listeners, at about a 13. That's down about 2.5 points from last week. So obviously vol coming in a wee bit there. And this is what we talked about before. The overall vol levels are still kind of low, and the realized vol in the indexes are certainly low. That's why we're seeing such alarming bids to the downside here in a lot of these names. The puts last week, 27.1% rich. And again, some of that is because we have such low vol levels overall that it's going to be percentage just a large number. But still, we're seeing that bid increase. This week now, 34.4% bid to the puts here in the week 3 October. So if you're looking at some near-term hedging opportunities and looking at buying these puts, get ready to pay some premiums. And as we were talking about in our other show earlier just today, you know, you're paying so much for these puts, and then you realize vol isn't doing much. And even on a sell-off, we are seeing the vol coming in. So you could easily get hurt on these puts. Even if you do get the sell-off that you were hoping for, the vol coming in could easily overwhelm any of the delta gains you're making on those puts. So that's a rough road to go down. Be prepared for that if you are going to pay that 34% premium for those puts in the S&P. In terms of the calls, it was about 16.7% cheap last week, 22.7% cheap this week. So the calls getting more offered, puts getting more bid out here. In terms of where the action was in the E-mini, it was the 4,500 calls, which is, I neglected to mention at the start of the show. We were coming in, the start of the segment, we had a 44.8475. So right around a 44.85. So the 4,500 calls, number one contract out here this week. Again, it makes sense. Almost 41,000 of these things traded this week, listeners. The big day was Tuesday with about 11,000. Wednesday had about 10,400. And Monday and today both tied around 9,500 contracts. So a lot of paper in the 4,500 calls as we flirt with and then move away from this 4,500 strike over and over again. Before we head on out of equities, I want to take a stop out there in all things small cap as well, because I know a lot of you have been paying attention to everything on the small and micro side. John, is this a part of the equity portfolio that has drawn interest from your clients over there at RJO, everything small cap, sir?
Without question. So, Mark, probably one of the more popular trades that we've seen off our desk over the course of the last 6 months has been the relationship between the Russell 2000 index futures contracts and the NASDAQ 100. And so really kind of our clients have been playing sort of the relative value relationship based upon what's going on in Washington, D.C. and this infrastructure bill. And so, as you know, early on in the year, following the Georgia elections and the Senate going to the Democrats and sort of having one party rule in Washington, the Russell 2000 outperformed the NASDAQ and the S&P 500 on the belief that there would be large infrastructure investments put forth by the ruling party in Washington, D.C. as time has gone on now, we have kind of come to see that trade reverse and reverse out. And actually the Russell trades kind of, on a relative value basis and on a historical basis has given up a lot of those gains versus the NASDAQ. And I think what the market is currently suggesting at current levels, and these are conversations that we have with our clients, is that the tax bills that come forth within this reconciliation package probably will not be overly burdensome to large cap technology stocks, Google, Facebook, and of the like. And likewise, too, the actual real infrastructure investment, roads, bridges, things like that, will probably be less than what the market had hoped for or expectations were earlier on this year. And then you'll see kind of money from these reconciliation bills and the infrastructure bills kind of go more towards the entitlement part of government, i.e. free community college, universal pre-K, items that really don't have what we would call at the desk sort of economic or financial multipliers, putting people to work, shovel ready, things like that, right? So for your listeners out there, we'd like to kind of raise that idea. Certainly conversations that we have with our clients is that, hey, when can the Russell outperform? And when can the Russell underperform? And recently, we've seen the NASDAQ sort of outperform the Russells. The Russell's giving back some of its earlier gains as, again, expectations for these infrastructure bills, these roads and bridges and these small companies and these small employers that sort of are the backbone of the economy have been scaled back.
Speaking of scaling back, let's get on out to the small caps over there, see what folks are putting on or perhaps scaling back. I got a feeling the latter out here in small caps. Check it out for yourselves. Go to that same drop down, listeners. Pull out of the S&P E-mini, head on into the Russell 2000. You'll see doing some decent paper this week as well. And of course, small caps coming into showtime at about a 22.39, net up about 0.5% from Monday's session out there. Again, same deal as with all equities. 30% of the paper this week going up in the contract, going the way of tomorrow pretty much. So again, kind of hard to parse that. But if you are wondering, let's see, the vol out here in small caps and some of these front contracts with a couple of weeks ago is around a 20 and a half. They have come in markedly about 4 points this week. So obviously below the RVX, which is more of a 30-day kind of rolling measure and also incorporates some skew. Just looking at straight at the money, it's around a 20. So we're talking about maybe breaking into the teens, even in small cap vol, which is kind of interesting. Structurally, they're usually more volatile than large caps. The action out here, though, a little bit different. We haven't seen in the past two major trades, really, in the Russell 2000, listeners. That is, a lot of people loading up on the quote-unquote small delta calls, particularly earlier this year when, as John was breaking down, small caps were kind of lumped into the meme frenzy and everyone was just gobbling up all things small caps. And we also have seen traditionally a lot of longer-term, pretty far out of the money puts also trading in small caps. And this week, that's kind of where we're seeing the action. The most active contract are the week 3 October 16.5 puts. Remember I said we're at about a 22.40. So you're talking nearly 600 handles out of the money, listeners, going up thousands of times this week. So yeah, a lot of action on these 16.5 puts. Seemed like most of it was on Wednesday and most of it was closing. So maybe this is the other side of the trade we profiled on the show in the past. This 16.5 strike does sound familiar. It seems like whoever was opening up out there, whether they were selling those puts or let's hope they were, they're taking them off now. Because if they bought those puts, that was A, expecting a pretty big downturn in small caps, and B, that didn't work out too well for them. So let's hope they were selling because they were taking these off the table this week. So unwinding of some downside puts out here. Other than that, we did see some small delta action. It looks like 22.45 calls trading going out next week, as well as 22.60s in a couple of weeks. So those are all not that small delta because they are kind of close to the at the money strikes. So, and also we saw, by the way, 16.5 puts going up in week 3. You know what? Looks like they went up also in week 3 November here. So you know what? Looks like they were closing, but they rolled. They rolled them all the way out a month. So from week 3 October to week 3 November here. So more of a roll. So they're not getting out of Dodge yet. They're keeping that 16.5 put strike alive, which is interesting and surprising. That's a lot would have to happen to see small caps back at that 16.5 level. Interesting stuff. What are your thoughts on that, listeners? Hit us up. Speaking of your thoughts, we squeezed a few of you in already. We'll squeeze a few more in as we wind down the show. A little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options. facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, let's squeeze some of you in here really quickly. Jackson wants to know, hey guys, well, hello, Jackson. What are your thoughts on the big S&P futures being phased out in favor of the E-mini and the micros? Does this change the game for futures and futures options traders? Well, certainly for a lot of the listeners of this show who tend to fall into the retail category, it does change the game for you folks. If you had to go out there and only trade the big S&P futures and options, that was a lot to bite off for most of you and wasn't really that viable for you. And even the E-mini, as we were talking about on our Option Block show earlier today, given what we've seen in the S&P 500 over the past decade or so, even the E-mini is a bit of a beefy contract. Hence the super ridiculous, some might say, popularity of the micros. You guys can't get enough of these. So they definitely do make it a much more attractive entry point for equity options out there for a lot of you who are looking to sink your teeth into these. I'm curious, John, what are your thoughts here on these minis and micros just blowing the doors off? And is that the case at RJO as well? Are a lot of your clients diving into these, or are they more on the institutional side, so they still prefer the larger products?
No, Mark, on the institutional side, we saw the transformation or the move over to the E-mini contract a few years ago. And, unfortunately, kind of given what the pandemic did to the industry in general, the pit traded large contract just, didn't really kind of become viable. But even before the pandemic, the move had the larger institutions had already moved a lot of their exposure over to the E-mini contract. And look, you really have to take your hat off to the CME group. They do a lot of things right over there. And this move to the E-mini contract was just another one of a long line of successes there. The contract trades 23 hours a day, 5.5 days a week. The big contract didn't quite do that when it was in the pit. Likewise, too, technology has come into the industry, right? And so, look, if a Fidelity, right, or a large equity shop, Vanguard, has a lot of let's say futures that they need to move, they can now utilize technology to do it. Here at RJ O'Brien, and on behalf of our clients, we like to use, algorithms and other technology advancements to provide best execution to our clients, and it maintains anonymity. We can use a number of different tools to provide not just anonymity, but also to kind of do best execution and take advantage of the depth of liquidity within the E-mini contract. So at the end of the day, the institutions have already made the move, and they well made the move ahead of the CME Group's announcement. But I think in doing such a thing, transferring a lot of that large, institutional open interest from the bigs to the minis, I really think one has to kind of tip their hat to CME leadership in terms of their slow, consistent, transparent migration and move towards the minis. I mean, they really handled it very, very well for all parties involved.
All right. Unfortunately, that music means we're coming up against it, listeners. But yes, it has been fascinating to watch. I found myself dating myself this week, John, referring to using the big S&P futures to hedge the SPX. It doesn't seem like that long ago, John, that they were rolling out the E-mini and they had to limit it to only 20. They didn't want to cannibalize the big future. Now here we are a few scant years later, John, and the E-mini is the belle of the ball, the only game in town, John. Crazy how that transition has evolved. Well, speaking of transitions, we have to transition on out of here. But before we go, Mr. John, if folks are intrigued, they want to hit you up like our listeners did today. By the way, our listeners seem like they enjoyed the show. The live folks chiming in, Nichols saying it was a great show. Frank 1209 saying he wants to thank you, John, for answering all of his questions. So glad to see so many of you folks are enjoying it. Remember, if you want to join us live, hit up the plus, hit up the pro, and you can join us live throughout the week for this show, everything else that we do, and also our exclusive pro content on Tuesday and Friday there as well. But before we go, John, if folks have questions, they want to reach out to you and the team over there at RJO, where should they go, sir?
Well, look, I think, Mark, I think the best place to go is go to the R.J. O'Brien website. Service has been our trade really since 1914. We're a privately held global boutique with a deep well of experience across CME products and across really sort of global commodity products and listed derivatives. Go to the website, see our website. We have a very strong retail franchise, arguably probably the strongest retail franchise there is, in the Western Hemisphere, if not globally. We certainly have an institutional product offering that competes with some of the most white shoe bulge bracket firms in North America. And so, really, I think for anybody listening to your show, which I certainly enjoy being on, Mark, and thanks again. But really, for anybody listening on your show who'd like to kind of learn a little more about R.J. O'Brien and our suite of product offerings, go to the website, see what we're all about, and do a little bit of a deeper dive into what we represent for our clients. We're pure agency brokers. We do not trade on principle. Our clients' best interests are our best interests. Please see the website.
Well, you know where to go. R.J. O'Brien is the place to go on the old web. And, of course, give him a follow on the old Twitter while you're at it, at R.J. O'Brien. Pretty simple to find there for all the nuggets and pearls of wisdom that they're tweeting out in between their appearances here on the show. We do have to get John back on to do the deep dive into Eurodollars you guys have been asking us for sometime in the near future. In the meantime, you guys know where to go to find all the great data we were just talking about over there in the land of small caps. What's trading out there? How is COVID impacting the small cap market? Volatility, a whole bunch more. Pleased to see there are some new weekly options coming on all things small caps pretty soon. I'm going to break those down in the show coming up in the coming weeks. You know where to go for all that data and a whole bunch more. FTSE Russell, FTSERussell.com is the place to go. Give them a follow on the old Twitters as well, at FTSE Russell, FTSE Russell, with 2 S's and 2 L's over there. And last but certainly not least, you know where to go for all of the reports we use throughout the show. They're all available for you folks completely for free. You are not that bright if you don't take advantage of us, listeners. You can't beat the price, and it's some of the best data you're going to get in the futures and futures option space. CMEgroup.com/TWIFO, TWIFO, or /TWIO. Both of those will get you to our reports. Remember, they're live throughout the week, not just during showtime. You can check what's going on in Class 3 milk on Sunday at 3 a.m. if you want. No one's going to judge you. And remember, tune in next week for TWIFO. Of course, we have more coming up tomorrow. We have volatility views at noon. Then we have options oddities coming up after that for you pro members at 2 p.m. Central. Then back again next Thursday, another episode of TWIFO. We'll see you then.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEgroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.